Hey guys, what's going on? My name is Hamishwhodder and we are back with another individual stock analysis. Today we are looking at, drumroll please, Winnebago. So today we're going to be looking at Winnebago Industries, and this one should be quite interesting because many of you would know that I hold Thor Industries in my portfolio, and Thor Industries is a direct competitor to Winnebago. So I think you guys will be interested to hear my perspective on Winnebago, and I think it's a really great company in isolation, but I'm also going to talk about how when you compare it to something like Thor Industries, why I think Thor Industries is superior. And of course, be aware that my opinions in this video are extremely biased because I do hold Thor Industries. So naturally, going into this, even though I have looked at Winnebago before I invested in Thor Industries, obviously I think that Thor Industries is superior in terms of an investment than Winnebago. Otherwise, I would have invested in Winnebago. But it'll be interesting for me to share with you my perspectives on the two and sort of compare them throughout the video. And a number of you requested that I look at this stock, so I thought that I would. And of course, I'll say it right now, if you have a video or if you have a stock that you want me to analyze in next week's video or later in this week, make sure you leave it down in the comments section below, because I read through all of your comments and I make a massive list of all the video ideas, and then I go through and pick a few video ideas, and that's basically how I've structured this channel. So if you want to have your say, make sure you let me know down in the comments section below. But if you enjoyed the video, make sure you leave a like. It doesn't take you too long and it helps me out a ton. Before we get started, I need to say that I'm not a financial advisor, and I'm certainly not your financial advisor. So everything here is just for entertainment and educational purposes only. I don't know your personal circumstances, so if you are going to be making any financial investments, please consult a financial advisor. As per usual, this video will follow the same structure as all of my other individual stock analysis videos. We're going to start off with a company overview. What is the company? How do they make their money? Then we'll have a look at that economic moat in a qualitative and a quantitative sense. We'll have a look at management. Are they effective at investing for us and managing their debt? Then we'll have a look at the value matrix. What kind of expected return could we make on this stock if buying at the current stock price? And lastly, we'll do that intrinsic valuation and come up with a buy, hold, or sell decision. So if you do enjoy this video, make sure you become a subscriber, hit that subscribe button, and make sure you hit that notification bell so that you don't miss out on any of the future videos coming out in the future. But for now, let's jump into it. So just briefly, Winnebago Industries, they're an RV manufacturer out of the United States, and essentially they're a little bit different than Thor Industries. They definitely compete directly, but in terms of Winnebago, their business model has changed dramatically over the past few years compared to Thor Industries, whose business model has stayed pretty much the same since they started operating in 1985. Back in 2016, 90% of their revenues came from motorhome RVs, but fast forward to 2018, 2 years later, only 43% of their revenue came from motorhomes, and 56% now comes from towable RVs. And this is essentially because towable RVs have just become way more popular in recent times relative to motorhomes. And I think there's a couple of pretty simple explanations for this. The first one is that towable RVs are cheaper generally. Generally, when you're buying a motorhome, it's going to be very expensive. You're talking $50,000 to $200,000 or even north of $200,000. And when it comes to towables, some of the towables are as cheap as $15,000, but they can also range up to over $100,000 as well. But generally speaking, they're a little bit cheaper. And if you already have a car or a truck that you can tow a caravan or an RV with, there's really no point spending a ton more money on a motorhome, because if you already have the car, you just need the caravan that you can tow it with. And the second reason is that pretty much everyone is in agreement that over the long term, fuel and gas prices are just going to increase. And that means that if you own a motorhome that has to be run on fuel or gas, that's just going to get more and more expensive over time. And granted, if you're using a towable RV with a petrol-driven car, that's also going to get more expensive over time. But if you get a towable RV, you just have the option to hook it up to an electric car, which wouldn't increase in price as fuel prices go up. So it just gives people a little bit more flexibility. And I think that is another reason why people are sort of shifting away from these motorhomes to just getting towable RVs for that extra flexibility. Another thing to mention is that the RV industry is highly cyclical, and it does appear as if we are near, if not at, the top of the latest cycle, although no one can really predict what consumer behavior is going to be like in the future. Winnebago's RV shipments forecast for the entire market is about 497,000 units, which is a 0.4% drop from 2018. And that basically means that if you're an RV business and you don't grow your market share next year, it's likely that you'll see your revenue decline. So the only way, if unit shipments go down, if they might not, but if they do, then the only way that you're going to increase your revenue is if you increase your market share, either organically or through acquisition. And essentially, Winnebago has had very good success, a very great success at growing their market share organically. And that's very different to something like Thor Industries, where they do grow their market share organically. However, a big part of their strategy has been acquisition and just buying up different businesses in the industry in order to increase their market share. And as you would know, Thor Industries recently bought up Erwin-Hymer, which was the biggest RV manufacturer in Europe. So they just bought 30% of Europe's market, which is pretty insane. So that's sort of Thor's strategy, and that's how Thor is going to increase their revenue next year, as that 30% of Europe's RV industry revenue is going to be now on Thor Industries' income statement. And in terms of Winnebago, their strategy is going to be to continue to grow organically, and we'll see how that goes next year. But they are quite confident in their ability to continue to grow at high double digits. In terms of price, Winnebago is currently priced with a market capitalization of $875 million, and that's with a PE ratio of about 8.5, and they currently pay a dividend of 1.5%. So that brings us to the economic moat, and we'll start with the qualitative moat, which basically means we're trying to identify some sort of characteristic in the business that is going to give it a long-term competitive advantage over the other businesses in its industry. And essentially for Winnebago, I think the biggest or most obvious qualitative moat that it has is a branding moat. And this is my least favorite kind of moat, because as people's perceptions change and as generations come and go, people's opinions about certain brands change, and brands become popular and they become unpopular again. So I don't think it's a really super great moat to have, although I think that's the only moat that Winnebago really does have. And of course their executives will say that their design and the prices of their products and so the quality of their products are superior to the other brands, but pretty much every executive in any company is going to say this, so I'd pretty much just take it with a bit of a pinch of salt, and I don't think it's a huge advantage that they have really over any other RV companies in their industry. And I think that's partly due to just the nature of the RV industry. Most RVs are pretty much more or less the same. Of course, different companies will come out with different models with different interiors and that sort of thing and different prices, but more or less they're pretty much the same. So the only moat that I think is a really sustainable moat is sort of a size/market share moat, which is what I think Thor Industries has, and I think Thor Industries is the only company that has this in the RV industry in the United States. So Thor Industries has this because they have 50% market share in the United States, and with their recent acquisition, they now have 30% market share in Europe. So that is huge worldwide market share. And what it means is that they can mass produce RVs, which means they can produce them more cheaply than other companies. And it just means that they have such huge amounts of capital available to them because they can operate cheaply, and because they're so big, they have so much capital available to them that they can just keep acquiring smaller companies and keep taking a bigger and bigger market share. And that's been the strategy for Thor Industries, and that's worked really effectively. But coming back to Winnebago, I just don't see, in terms of a qualitative sense, what kind of moat they have. But of course, we need to look at the numbers. We need to see if there's a quantitative moat, and that's the most important part, to see if their numbers are growing over time and that their numbers demonstrate that they have some kind of a long-term competitive advantage. Just before we jump into the spreadsheet, if you do want access to the spreadsheet that I use in all of my analysis videos, you can get it via the link down in the description below. And I actually brought out a video yesterday talking about the latest updates I made to the spreadsheet and how to use every aspect of the spreadsheet. So I suggest, if you want to use it, go check out that video and click the link in the description below in order to get yourself a copy of it. But let's jump over to the spreadsheet and let's have a look at these long-term growth numbers. So Winnebago's growth has been exceptional over the long term. Sales growth has been 28% over a 9-year period, and in the last year it's been 30%. EPS growth has been extremely strong, above 20%, 40%, almost 40% this year, which is really great. Equity growth, which is a really important one, that was 22% over the long term, and pretty much staying between 20 and 30% over that time. and free cash flow growth, again, very, very strong, except for this year where they had a dip in their free cash flow. So the numbers for Winnebago are very good. Clearly, they've fundamentally been growing at such a high rate over the past 10 years, which is excellent. It's exactly what we like to see. But now we have to have a look at the management's effectiveness, and we like to look at it over two dimensions. First, we're going to have a look at how they've been investing their capital, how effective they've been at getting a return on their investments. And then, of course, we want to look at how they've been managing their debt and ensure that they don't have any out of control debt obligations. So we'll start off with the invested capital. And of course, we like to look at the return on invested capital for this. Over the long term, over a 5-year period, their return on invested capital has been 18.4%, which is excellent. It's well above the 10% minimum requirement. And in the last year, their return on invested capital has been 15%. So still above 10%, which is great, but their ROIC is slowing down, which is not something I like to see. In terms of debt, the current ratio for Winnebago is 1.82, which is just below my minimum requirement of a current ratio of 2. So I think it ticks that box. It's pretty close. And in terms of the debt to equity ratio, they've got a debt to equity ratio of 1. And I like to see a debt to equity ratio that's below 0.5. But a debt to equity ratio of 1 isn't too bad. It's just not great. I like to see that a company has more equity than debt. So that brings us to the value matrix, which is where we can calculate what kind of return we could expect to make over the next 10 years if we started to invest at the current stock price. So basically, to do this, we need to estimate the growth of Winnebago over the next 10 years, and of course, the PE ratio of Winnebago over the next 10 years. Now, the PE ratio is fairly easy. We can just look at historical charts for this. And as you can see, besides a couple of times where their earnings were considerably lower, their PE ratio tends to bounce between 20 and 10. So that's the range that we're going to be using in our value matrix. Growth is a bit harder because this is a high growth cyclical company that's near the top of a cycle. In terms of analysts, they're suggesting 15% over the next 5 years. However, if we have a recession in that period, it's almost certain that their growth is going to be negative over that 5-year period. So I want to be much more conservative with my growth rates over the next 10 years because we don't know when we're going to have that recession and when their earnings are going to be hit significantly. So I've used growth rates between 2.5% and 12.5%, and then of course we've used PE ratios between 8 and 22. And that basically means that we think the stock price in 10 years time is going to be somewhere between $32.97 and $230.04 per share. And essentially that equates to an annual return of 2.02% to 23.89% just from the stock price appreciating. Now remember, Winnebago also pays a 1.5% dividend, so you would also get the dividend on top of this return. And this is a pretty good value matrix. It means that even if they grow really slowly at 2.5% and an 8 PE, which would be a disaster for a company that's been growing at 30% per year, then you would still make sort of a savings account return, which is pretty good because you'd make the 2% plus maybe a 1.5 to 2% dividend per year. So you'd make about 3.5 to 4.5% per year, which is a good worst case scenario. And if they grow at just 10% over the next 10 years, which is very possible for a high growth company, I wouldn't say it's easy to anticipate that, but it is possible that could happen. It's very likely that could happen. 10% growth and a PE of 22 would mean that you would get a return of 21.14%, which is a huge return for a business like this. So you can see that there is a vast range of outcomes. There were some really strong outcomes, and even the weakest outcomes are still quite good in terms of compounding your wealth over a 10-year period. So that brings us to the intrinsic valuation, and for this we will use my buy zone calculator on my spreadsheet. And essentially, if we use the analyst's growth rate over the next 5 years, which is 15%, the stock is actually a buy. That gives us a fair value of $53 and a buy price of $26 when the current stock price is about $27. So that would mean that it is a buy if you think that Winnebago Industries can do 15% growth per year for the next 5 years. Personally, I think that's ridiculous because if we have a recession any of those years, it's likely that their earnings will be negative. And I don't think that you should be investing in cyclical businesses over a 5-year period. You need to look way beyond that, because you don't know when that recession is going to happen, and you don't know when the cycle is going to dip. I think that the cycle might not dip for another couple of years, which would mean that in 5 years' time, they might still be coming out of that cycle. So it would take at least 10 years for you to realize a high rate of return on a stock like this. Personally, if I was going to be making an investment in Winnebago, I'd want to use a much more conservative growth rate, something like an 8, which would mean that the fair value would be about $38.50, giving it a buy price of just under $20 per share. So that would be about a 25 to a 30% drop from where the current price is right now. Now, I will mention that if we use the same growth rates and the same PE ratios to value Thor Industries and Winnebago, Winnebago actually looks cheaper. And you might think, well, then why didn't you invest in Winnebago? And basically it's because price isn't the only thing. Price is definitely important, but there's the other factors. There's what's actually happening in the business. And for me personally, I think that Thor Industries has much better, much easier to predict future cash flows, and I just feel a lot more confident in estimating and using an 8 to 15% growth rate for Thor Industries than I would with Winnebago. So that's all for today, guys. I hope you enjoyed this one. If you did, make sure you leave a like and let me know your thoughts down in the comments section below. If you're new around here and you enjoyed this video and you want to see more, make sure you hit subscribe, hit that notification bell so you don't miss out on any of the future videos coming out on this channel. But for now, guys, I hope you have a great day, and I'll see you in the next one.